natural gas.
Natural gas.
Natural gas.
Natural gas is one of the most traded commodities in the world. It's the third largest energy source, representing over 23% of the market. And its historic dynamic price changes have made it appealing to traders. But how do you trade natural gas? First, let's give the natural gas market some context. It's all about supply and demand. On the supply side, when it comes to the global stage, a few heavy hitters dominate the market. The US, Qatar, Norway, Australia, and of course, Russia. The US holds the top spot, accounting for nearly 22% of annual global production, with Russia, the previous king, now in second place, with almost 15% despite the troubles in Ukraine. On the demand side, unsurprisingly, are some of the largest economies in the world: China, Japan, Germany, Italy, and South Korea. And only China has its own significant natural gas reserves. So how is natural gas traded? Well, it's physically traded through a system of distribution hubs, like the Henry Hub in the USA or the Dutch TTF in Europe, both of which are seen as the benchmarks for pricing. But the market itself is traded on exchanges in several different ways. And one of those methods is CFD trading. A contract for difference, or CFD for short, is a form of derivative trading. CFDs are contracts between a trader and an exchange or broker, in which they simply trade on the price of an asset instead of owning the actual asset itself. Now, it could be the spot price of Henry Hub natural gas, for example. Traders are able to easily go long or short and usually have the ability to use leverage, which is when the broker will effectively lend the trader additional money. This allows the trader to increase their position without fronting all the money, so they can potentially capitalize on smaller price movements. Keep in mind though that different brokers will offer different amounts of leverage and limits may apply. Now, whilst leverage offers the potential for greater profits, it also increases the risk of larger losses, so make sure to use appropriate risk management. For traders that want to trade in the actual underlying natural gas asset, the most common method is futures contracts. Futures contracts are a commitment to buy or sell an asset at a fixed price and delivery at a future date, otherwise known as the expiry of the contract. The aim of a futures trader is to lock in a price with the hope that it then moves in the direction that they predicted by the time the contract expires, hopefully banking them a tidy profit. The other party in the contract is working on the basis the price will move in the opposite direction, delivering them a profit. But obviously both can't be right, and ultimately one person will profit whilst the other will make a loss. Now, it's important to point out that most traders of natural gas futures aren't interested in handling any actual natural gas. What they're actually trading in is the contract itself. Now, there are some other parts of natural gas futures contracts that are useful to know. In futures contracts, natural gas is often measured in metric millions of British thermal units, or MMBTUs. A mouthful, I know. But unlike CFDs, which allow for much smaller increments to be traded in, as it's merely trading on the price, most futures contracts hold a minimum of 10,000 MMBTUs. Now, let's say the spot price for just 1 million British thermal units is $2.50, which is roughly the current price. To buy just one contract, that would cost a trader $25,000. I know what you're thinking, that is a lot of money. But a futures trader often won't spend that much, as they may use the previously mentioned leverage to up their position. Okay, so what happens once your futures contract expires? Well, a trader will notionally be expected to take delivery of that natural gas. But, as previously mentioned, it's more likely to be a cash settlement than tankers full of gas arriving at your home. But be sure to check what the contract specifies. There are ways to avoid this though. The first one being something called offsetting the position. So it's the simplest and most common method of getting out of a trade. You're using a counter trade that neutralizes the first one. The gains or losses hinge on the price difference between the initial trade and when it was offset. Then the second way is known as rollover. Extend the investment by offsetting the current position, but then buying into a new contract with the expiry further out. Which choice a trader makes depends on if they have a long or short-term strategy, or want to minimize their losses or take their profits. Next on the list are options. But in simple terms, these give traders the option, but not the obligation, to buy or sell an asset at a specific price level, otherwise known as the strike price. Because it's a choice other than an obligation, traders have to pay a premium on them. They're generally divided into two camps on either side of the strike price: the call and put contracts. If a trader thinks natural gas prices will rise, they'll opt for a call option, essentially giving them the right to buy the contract at the strike price. If they smell a downturn, they'll grab a put option, giving them the right to sell at the strike price. If the natural gas price beats the strike price, the trader has earned a profit. If they're on the wrong side of the strike price, they will take a loss from paying the premium. Now, before we go any further, just a bit about us. Here at Capital.com, we make explainer videos about trading and economics, giving you insights on the markets so you can make informed trading decisions. We're also a trading platform, so you can make your trades right here on our website or using our app. After this, you might want to check out our other videos on whether a stock is overvalued or undervalued. Now back to it, and let's talk about a way of trading on the natural gas futures sector without having to deal with the actual futures and options contracts. Exchange-traded funds, or ETFs in natural gas, are professionally managed portfolios. Think of it as trading the natural gas futures sector, rather than the trader having to deal with the commodity itself. They track a collection of futures contracts that the ETF manager has invested in, offering a slightly different trading approach. This is a more passive and diversified way of managing your portfolio, and is a way for traders to indirectly participate in the natural gas market without dealing with the futures contracts directly. Finally, another way for traders to access the natural gas market is through stocks. Stocks are essentially buying a stake in a business. In this case, traders might want to explore companies that are active in the natural gas sector. Extracting, processing, and transporting natural gas is a pricey endeavor, and the success of a natural gas company's stock can come down to both exploration as well as supply and demand, which are both risky business. There are many natural gas stocks to choose from, so make sure you do your research. Hopefully this video gave you an overview of how to trade natural gas. Thanks for watching, and don't forget to like, comment, and subscribe. And we'll catch you next time.